Hi, my name is Jeff DeWeese. I'm the Chief Investment Officer at Auric Capital Partners. Today we're going to talk about capital gains. Tax loss selling or tax loss harvesting comes into play when your security's current value is less than what you paid for it. The government always wants to collect taxes from us when we make money, but in this instance, they actually give us a break and share our loss. As you can imagine, there are some specific rules that need to be followed when doing this. You cannot invest in a substantially similar security, and the time frame for that is 30 days before and 30 days after the loss trade. So, say you have 100 shares of XYZ stock. It is at a loss, so you buy 100 more shares on June 1st. On June 15th, you sell the 100 shares that are showing the loss. In that case, you would not be able to take the loss. In addition, you can't buy the stock back until July 15th, 30 days after. This also goes for similar securities. So if you owned a popular gold ETF like GLD and sold it for a loss, you cannot buy another gold ETF like IAU. You could, however, buy a diversified commodities fund to hold for 30 days and then swap back into your original GLD position. This may sound like a big hassle that may not be worth it, but I think it is. Any losses you take can offset any gains that you may have. So if you have $10,000 in realized gains and $2,000 in realized losses, you would only report an $8,000 gain, cutting your tax bill by 20%. Notice I said realized. Only realized gains and losses are reported. Realized simply means that the position was sold. You may have a lot of unrealized gains in positions that you're still holding, but taxes don't come into play there for those securities until you sell them. Another benefit of having some losses is that your realized losses exceed your gains. Then you can take up to $3,000 off of your income. In addition, these losses don't expire. These are called loss carry forwards. So if you have $10,000 in gains and $40,000 in losses, you'd have a net realized loss for the year of $30,000. It doesn't sound great off the top, but really having those losses can be useful going forward. You can apply those losses to future tax returns. A good example of this is when the Fed spiked interest rates in 2022. Bonds got hit hard. In many cases, we were able to take the losses in the bonds, reinvest at the new higher rates, and set up clients to offset future gains and income. So at Auric Capital Partners, we engage in tax loss harvesting all year long, not just at the end of the year. By doing this, we try to minimize the amount of capital gains tax our clients have to pay. Stay calm, stay diversified, and stay positive. We'll see you next month. And from all of us at Auric Capital Partners, we wish you all a great day.